Hey everyone, welcome to CoveredCall ETF Investing. I'm Jordan and this is your central hub for deep CoveredCall ETF data. In today's video, brought back by popular demand. I've been getting a lot of questions about this recently, about doing a full-on portfolio overview. It's probably been since April that I've actually done a full overview where I discuss performance, I discuss my philosophy around income investing, the allocations inside my portfolio, but really to give a real substantial breakdown of what it is that I am currently doing and what I plan on doing. So let's get into that right now. All right, everybody, I'd be remiss if I didn't start a video like this without a couple of shameless plugs, but if this is something you want to skip, then I'll just put a little chapter in there that you can fast forward to the actual portfolio review. But there might be some stuff in here that could benefit you. So as of right now, I'll keep it quick. I do basically coaching, mentorships, one-on-one. The reason for doing this, one is, as a content creator, this is a highly recommended way of engaging with your audience and connecting with people and learning their pains and problems with the things that I talk about. Speaking with you guys one-on-one is, or even in group setting, is one of my favorite things about the channel, actually, is to hear real stories from real people and kind of help them on their self-guided learning, which is really what these one-on-ones are about, is to help you become more self-guided in your own learning and maybe get past some of the humps that might be in your way, or those pains or problems that might be in your way, to help you kind of quicken the education around these funds. Now, I've gotten the question, which I'll address here. One-on-ones, am I a financial advisor? No, I'm not. And I mean, there's always going to be disclaimers when it comes to that, whether it be in the channel description, whether it be in here. Even when I was doing one-on-ones for 6 months and I was doing them for free, I always told people right at the top of the talk that, guys, I'm a pipe fitter, and if that bothers you, we can stop the talk right now. Not one time did I have anybody say, I didn't know that, I'm out. I don't want to hear your opinion. That's never happened. I always want to be upfront when it comes to that. I understand this is a regulated industry, so I do take measures to make sure that that I honor those an industry that's regulated like finance. And one of the ways I do that is, you can actually see it in the channel itself, like through the content that I produce. It's what you don't see are titles that are clickbaity around, you must buy now, panic sell this, here's what I'm buying today. I try to avoid topics that elicit a recommendation. Yeah, I'm not going to say I'm perfect in that regard, but that is what I try to do. And I'm going to approach one-on-ones like I approach the channel in that regard. It is really from one DIY investor to another. How have I learned how to use these CoveredCall ETFs, and what things can you use within, say, you could learn maybe off of me, that could naturally just help you in that regard. If you're interested in that, there are also some topics that I put on the sidebar here. There'll be a link in the description below. I got one slot left in July, but anyway, I got a little sidetrack there. There are some topic questions or topics of discussion we can certainly discuss if you're wanting to do that. I'm probably only going to put out a couple of sessions every single month. I'm married with 3 kids, so life is very full. But anyway, this is a great way of just connecting with you guys. And if you value this content, you think you can, you feel like, learning about philosophies around income investing, we can even go through the CoveredCall ETF ALLSTAR tracker, which is a spreadsheet I've developed. If you want to go through that, we can certainly do that. Pretty much anything. So if you're interested in that, just head to the description below, and I'll post probably something for August fairly soon. Next up is the CoveredCall ETF ALLSTAR tracker. I launched this back in January. It is a consolidated list of performance data from Yahoo Finance, Google Finance, and also info that you would find on a fund manager website. So it talks about distribution changes, again, performances, from price performance to total returns to just yields that are updated on a daily basis. All of this data is now live. That's something I had always worked towards, and as of July, that is the case. So you can pick this up on my Patreon for $13. I think it's a great deal for a list of like 200 plus. I think it might even be, about 200 plus CoveredCall ETFs on the Canadian side, the American side. I got a few other tabs for taxes, distribution history, average volume, and how average volume has changed month over month, AUM changes, volumes that I'm tracking over time. It's really about tracking the health of this industry as I plan to invest in this stuff for the long term. So I get to show that on the channel, and you get a little bit more behind the paywall, of course. And another great feature of Patreon as well is that I like to do workshops and Q&As and Zoom Hangouts every single month. So the next one is called the High Yield Hangout on Saturday, July 27th at 9 a.m. Pacific time. It's about half full. They're really meant to be small group oriented. I never really want more than 10 people in these things. Luckily, the Patreon is small enough that we never even get to 10 anyway. There's probably about 5 spots left. So there's about 5 of us that are going to be part of this. But it's a great opportunity to learn about strategies and taxes and how other income investors are using their portfolios to enhance their quality of life, or how to use these funds to gain a certain measure of return. So even if you're maybe even shy or feeling a little bit introverted, you don't normally do something like this, I'm telling you right now, it's for the kind of value that you're going to get from other people. It's immeasurable. And I guarantee you there's other introverts. Most people who are invested in finance, I think we're all kind of more introvert leaning anyway. And I can attest to that myself. Despite having a channel talking to you all guys, I think I'm much more introverted in nature than maybe you guys probably realize. Okay, so we're going into the meat and potatoes of this whole thing. And I'm going to go through it fairly quickly, just for time's sake. I want to show you guys how much the portfolio has grown since I joined Wealthika, which is a portfolio aggregator tool. Basically, it's the one-stop shop that can compile all your different accounts into one place and give you some pretty unique data. So let's just go through that. But I know this is kind of interesting for you all to see how my portfolio has grown over time since I joined Wealthika back in early 2023. And you can see that I started at probably about $109,000. And as of today, the portfolio it's crazy. It's almost, not quite, but it's almost doubled in that period of time. That's not what I expected, but through contributions and through reinvesting, and just of course market participation, the performance of the market has certainly helped out in that regard to get it to where it is today. So very happy with how it is performing so far. Let's get into just the breakdown of how every individual fund that I'm invested in, how each of these have been performing. And we'll kind of measure that by total return on every single fund. Now you'll notice this right here is total return, whereas everything over here is just price performance. So total return naturally is how it includes the price performance of the fund, but also the dividends as well. So HYLD, it's a little bit of a misnomer. The data gets a little bit skewed when you buy something, but then you start trimming it. It makes it look like I've made a total return of 56% on a book value of $14,000, or I've generated $6,000 on $14,000, and that's just not the case. I haven't had HYLD that long to do that, but that's simply because HYLD was a huge, it was basically my entire TFSA at one point, but then I trimmed it to where it basically is today. So unfortunately that is a bit of a misnomer, but everything else, it really is a true total return. You have HTAE, total return 33%, but its price performance is 26. Absolute rocket fuel inside of my TFSA. Been really happy with HYLD.U. I swapped out XYLD for HYLD.U back in August of last year. Really happy with the total return performance and even just the price performance alone with that. BMAX. It's the buoy during the bad times, but it's the mini rocket fuel during the good times. Really impressed with BMAX, and yeah, it basically has an allocation that I'm really happy with inside the portfolio. HDIV never cut a dividend, and total return 16%, while its price performance is up 6% since I've owned it. Basically it's a split between Canadian and American type stuff. So yeah, either way, I'm happy with the performance. HDIV and HDIV basically perform, like I would say these two funds perform in a way that I originally expected my strategy to perform, which basically is to say a little bit of growth over time, and then but still being able to extract the distributions along the way. And that really is the core of my strategy is I really want to have the ability to yes, compound, reinvest over time. That's all good, but I also want to have the ability to extract at any point, even for 12 months, 18 months, 2 years, if I really felt like it. Want to have that flexibility, but have the confidence that these funds will still grow in price performance over time, ideally match, if not do a little bit better than inflation as far as price performance is concerned. So these two funds more or less perform along those lines, but I'm extra, I would say, impressed with HDIV just because it's never cut its distribution and it's been raising it slowly over time. And then HDIF performs exactly how I'd want it to perform. ENCL, this fund is just purely pure Canadian energy, so it's total return 15%. I also got a couple of bank CoveredCall ETFs in here. Total return, everything is up, minus the price performance of those sector ETFs. But interest rates have certainly affected sectors like utilities and banks. So look for that turnaround once we start to see some more significant interest rate reductions. EQCL is the newest member of the family here inside the portfolio. I swapped out USCL for EQCL, mainly because EQCL and now has everything inside of it is CoveredCall based, whereas its emerging markets and developed markets funds were not CoveredCall ETFs before. But I basically had my eye on this thing since its inception back last October. And now those emerging markets and those emerging markets and developed market funds are now fully CoveredCall ETFs. So that was as soon as that happened, I bought into it. And we should look for a distribution increase now that everything is now CoveredCall based. Now, I did give up USCL for it, but really half of this fund is basically USCL anyway. There's a little bit of QQCC in it. There's a little bit of some Canadian stuff in it. And then, of course, it rounds it out with the emerging markets and developed markets CoveredCall. So just, it's a global fund. I like that geographical diversification. My TFSA is very heavy with U.S. stuff. That's where I believe most of the growth will be. But the U.S. hasn't always been the best performing country. In the 2000s, people, I think, easily forget Canada outperformed the U.S. indexes for a whole decade. Now, it was commodities driven during that era, but that's just something to keep in mind in case we do see times like that again. Anyway, that basically rounds out the performance of these individual funds. Everything's in the green. Happy with all of it. And because I don't sell all that often and I just buy for the long term, all of this will increase over time, no doubt about it. I don't plan to touch my TFSA. I'm gonna ideally let that compound, but it's there for flexibility if I need that income for for whatever purpose. And as we get towards the end of the video, you'll understand why I need that flexibility. Okay, let's go to just performances versus those other indexes that I talked about. Now, to my surprise, I believe this is, what are we looking at? Let's do year to date. Here, let's change the range to January 1st. Okay. To my surprise, ever since the beginning of the year, my portfolio overall, my wife's spousal RSP and my TFSA, to my utter shock, this is the performance so far. I'm wedged between the NASDAQ 100 and the S&P 500. This I did not expect. This is not typically how these funds are supposed to perform. I would expect it to be under the S&P 500, maybe somewhere in the middle range, somewhere in maybe here, but it just goes to show with a certain combination of some of these funds that are kind of more growth oriented in nature, that can still pay out that higher yield, it can certainly keep pace. My goodness, can it keep pace? And for half the year, even though I didn't really talk about it that much, my portfolio was beating the NASDAQ, and only recently, maybe within the last month, it started to overtake it. But there it is, yeah, wedged right between the NASDAQ and the S&P 500. Now, I do suspect my portfolio, I do expect it to beat the Dow Jones. I do expect it to beat the TSX 60. So those indexes I do expect to beat, but these other ones, I mean, I think long term it doesn't, but anyway, this year is proving to be quite a fruitful year for my portfolio. So up, total return 20.79%. All right, let's move on to, let's actually look at income. What kind of income generation have you seen from my portfolio in this year? You know what, we'll go the last 12 months. That's what we'll do. Okay, last 12 months. Last summer, there was so much talk around recession, and so I kind of held a little bit more cash. I sold off some stuff, held cash, kind of waited, and then I was like, forget it. I don't think this recession thing's going to happen after all. That was probably a good choice because we never really saw that recession that so many people were talking about. But anyway, back in September, I was earning about $1,446 every month, and that has slowly been increasing through, again, reinvesting through the funds growing their own distributions as well. I'm now basically up to almost $2,000. I'm still waiting for BMAX to pay out. They usually pay out on the 15th of every month. So as of right now, as soon as I get that, I should match last month's. It won't grow anymore. The reason behind that is the switch from USCL to EQCL. USCL has a higher yield, so I slightly decreased my overall yield, but by August then it should start growing again, just because I am keeping EQCL. But it'll match June's roughly, and then we'll probably start to see that growth trajectory once again. But I've seen some tremendous growth over the last year as far as distributions getting paid out every single month. So that basically rounds it out for income generation over that period of time. I mean, over the course of 1 year, basically up almost $550, I think, has been tremendous growth. I think over the span of, say, 10 months, that's probably that's like a 25% growth in distribution over 10 months. So I'll keep going with that. Exciting times to be an income investor. All right, looking into Passiv, which is an asset allocation tool that's free. Basically, once you have money inside of your investing account, it'll basically tell you what to buy based on your target. So let's just start with my spousal RSP. It's a pretty boring account. It's it's just one fund. I'll keep it. I'm pretty picky when it comes to American stuff. But nonetheless, HYLD.U has just been doing so well for me, so why change it out now? But, I'm always open to look for other things to add, potentially sell off a little bit of this, but I got to have a good reason to do it. Haven't found that good reason yet. My TFSA is the much more exciting portfolio to look at. In the blue, we have the target allocation that I want, and green is where it actually is. So some of these you're going to see 0%, and so the reason behind that is these are Canadian sector funds. And many months ago, I decided that I no longer wanted to buy more. I didn't want to buy any more Canadian sector CoveredCall ETFs. Instead, I plan to use things like BKCL, things like HMAX, things like UMAX and ENCL. I'm going to be putting that in a taxable account, which will have a much different goal than my TFSA, which is yield-seeking, growth-leaning. But in my taxable account, it's going to be yield. It's going to be focused on tax efficiency and higher yields, whereas my TFSA is kind of focused on a yield of 10 to 12%, with price performance that ideally can match, if not beat, inflation. Being able to live off of the distributions if need be, or extract them whenever I want for however I want, how long I want. I want that flexibility with that portfolio invested in more American style stuff. That's where I see the growth coming from. But in the taxable account case, I want a yield maybe in the range of 15 to 17%, maximum tax efficiency. I'll probably put it in my wife's name because as I earn, I'm the sole income in the family, and she has the tough job too of taking care of the kids, but that obviously that is non-taxable. So so we'll probably put that taxable account in her name just so that we can save on taxes as best we can. As we kind of go through the list here, BMAX I recently gave an allocation raise to. It was at 7%, now at 10%. BMAX is just the steady Eddie in the portfolio, the buoy during the bad times, and as the little mini rocket fuel during the good times. EQCL, just swapped it out. I like the global diversification. Along with fund manager diversification, the US-based stuff, over the long haul does perform the best, but there's going to be periods where, like we saw during the 2000s, where it doesn't perform the best. So not a bad idea to kind of mix it up just a little bit, just enough that can kind of offset that potential. Then I got HDIF. I did have a target of 17%, but I lowered it. HDIF meets expectations, but a bunch of other funds have exceeded my expectations, like BMAX, like HDIV, which was at a 17% target, now at 19%. HYLD is in the same category, was at 17%, now at 19%. So I basically took 7% from HDIF and put it towards BMAX, HDIF, or I should say HDIV, and HYLD. And HTAE is a pure tech CoveredCall ETF. It is unlike those other NASDAQ 100 CoveredCall ETFs, whereas you got to just remember the NASDAQ is not 100% tech focused. It is tech heavy, but not tech focused, whereas HTAE is just 100% pure tech, which is what I like about it. It is the adrenaline when it comes to tech CoveredCall ETF and their performances. And HTAE also has a really respectable 10%. I get excited about 10% yielding funds, but it's just crazy to me that like 10% is kind of like a boring number now. It's there are much more enticing yields out there, but I still like anything above 10%. I'm super happy with, and I want to say my average yield right now with HTA is probably around 11%. All right, then we got HYLD. This fund has changed so much in the past year. It kicked out a lot of Global X funds and Horizons ETFs, which is, well, ironically Global X now. It really is a different fund altogether, but it is much more of a growth-leaning fund in so many ways now, especially because QMAX and SMAX make out the bulk of HYLD, and those two funds are more or less coalesce with the S&P 500 and the NASDAQ 100. So HYLD, much more growth-oriented in nature, and its distribution has raised so many times this year that it is now at the highest point that it's ever been, even despite the major cut that we saw last April in 2023. So that basically rounds out the TFSA here, and as far as the allocations are concerned. Now let's get into kind of the philosophy, like what it is that I'm trying to do with this portfolio. So my goal with this portfolio, for those who don't know, is to use basically a taxable account to offset the cost of a future rental that I want to get into. I am done with home ownership. As a single income with 3 kids, married, I do not have the ability to confidently buy a townhouse, buy a house that I feel like that one, we could afford, and 2, wouldn't diminish my quality of life. And quality of life is so important. I don't care about really owning anything anymore as far as property is concerned. I would much rather, own equities, because honestly, if an earthquake hits tomorrow or hits a rental, it's kind of like, well, my investments go wherever I go. They're not. Tangibility of an asset is a great thing, and I know that has its merits for me. That does not currently in time. So next year I'm going to be selling off my condo that I bought in 2017. I'm going to take the equity from the sale. I'm going to put it into some very higher yielding Canadian covered call ETFs like ENCL, BKCL, UMAX, the 15 to 17% yielders. And I'm going to use that income to offset the cost of a rental. And for my wife and I, we really want to get into a house in our target neighborhood. We're looking at a budget of probably, on the upper end, probably no more than maybe $4,200. If we get it for a little bit cheaper, that's even better, but that's kind of our upper limit. Now, to a lot of people, I understand that $4,200 is like, that's insane. That's a crazy amount to invest, or, to pay for anything. But using those higher yielding funds to offset that cost really actually brings our all-in costs to a level that is basically unchanged to what it is today. So that's why I'm very confident that I can afford something like this. And also, too, it gives my kids the opportunity to grow up in a neighborhood. It's a little bit harder meeting kids in a condo. There really isn't too many of them around. So just the fact that I can maybe send them out, go into the backyard, go into the neighborhood, go play hockey, go do whatever. That's how I grew up. That's how my wife grew up. And we do value that tremendously, and we want that for our kids. And also, too, we just need the space. We'd also, we're kind of a loud household, so we don't want to having our own space where we can be basically as loud as we want. And by loud, I mean specifically, of course, the kids can be as loud as they want without having to worry about neighbors down below or basically on all sides of us. To break the back of really wanting home ownership, it's been a unique experience kind of going through that, because growing up I always thought I'd own a house, but it's just in Vancouver, in our target neighborhood of Vancouver, it's just unfortunate. I can't, there's just no way to do it. And I make a pretty respectable living, especially with my wife being able to stay at home to look after the kids. We're just at that cusp of like, we can just do it, because if we were living even in a townhouse right now, if we had a bigger mortgage, there's just no way we'd be able to do it. So this is how covered call ETFs, income investing in a very tangible way, is going to impact my life. And I think it'll, as this comes to fruition and I'm able to speak about this experience more, I think it'll also add a value of intrigue to the channel as well. So that ultimately is what I'm trying to do with the CoveredCall ETFs in the short term. And as always, right, if you like what you see, now that we're basically at the end, if you like what you see, hit all the buttons of the like and subscribe variety, and I will see you all in the next video.